Today, you will finally understand the truth about growth and dividend investing and find out why you have been lied to when it comes to building your investment strategy. I will first present to you what dividend and growth investing is. Then, I will give you the real data you need to know in order to properly compare the two styles of investing and not the false information you're used to seeing all over the internet. In this part, I will include real examples of companies and funds with data you've probably never seen before. Finally, we will discuss something almost no one talks about. I will go beyond the pure math and dive deeper into the practical and psychological consequences of each strategy, allowing you to make a fully educated decision. My name is Ognan, and I welcome you to the Dividend Method channel. In this video, we get into probably the most heated and important topic in the investment community. A topic that underpins all your investment decisions and ultimately your whole investment strategy. Literally, if you're not familiar with the details of the growth versus dividend investing debate, you cannot even begin to invest without doing it blindly. Before I begin, something to note. I will mainly talk about the stock market, but also about investing as a whole. And one of the examples I will give will be about real estate, not stocks. So, for the purpose of the video, you can freely replace the word dividend with the word income and cash flow, and the word growth with capital gains or price increase. Let's begin with defining the two terms. Growth investing, broadly speaking, is a strategy focused on capital appreciation, which is a fancy term for price increase. Basically, what growth investors do is invest in a stock and wait for the price to increase. The only way they make a profit is when the asset is sold at a higher price. On the contrary, dividend investors, or more broadly speaking, income or cash flow investors, put their money to work in an asset that pays them for owning it on a regular basis. That asset can also be sold for a profit at a later date if the price has increased, but that is typically not the focus of the investment. Now, let's get to the advantages and disadvantages of each one. Here, I will give you the general quick overview. After we finish with that section, I will do a deep dive with charts, numbers, and also the real-life practical lessons that you probably have not seen anywhere else. Let's start with the advantages of growth investing. Generally, it is accepted that growth investing brings higher returns alongside higher risks because it is focused on not yet proven but rapidly growing businesses that are most of the time in newer industries. Think AI, biotech, crypto, cybersecurity, robotics, etc. These companies are expected to grow their earnings faster due to the exposure to secular trends and their expansion from a smaller starting point. The line gets a bit blurred here because companies like Microsoft or Johnson & Johnson are both exposed to sectors with huge innovations happening all the time, the technology and healthcare sectors, yet they are also more established, large and stable companies with a lot of history and are both dividend payers. Regardless of those outliers, generally these companies don't pay any cash flow to their shareholders and reinvest everything back into the business. This has one major advantage and one major disadvantage. The advantage is that the company expands their business faster if they reinvest everything back in it, potentially allowing it to capture more market share and dominate its rivals. However, the disadvantage is that if the company makes a wrong move, it might have kept your money for a decade, not pay you a dime, and then go to zero. So not only do you lose your invested capital, but you never even got a single penny from the business. So this is always something to keep in mind. Another advantage of these types of investments is that they're most of the time more tax efficient. You will see in a bit why I say most of the time. The general rule is that when they reinvest back into the business and they're doing well, their share price will grow, and that represents a so-called unrealized capital gain, which doesn't trigger any taxes for the investor. It is unrealized because you have not sold the stock for a profit. However, as I said earlier, there are situations in which this isn't true. One such situation is if you have to rebalance or take profits often. In that case, you constantly have to sell shares that have gone up in price, triggering the so-called capital gains tax. Another reason why these investments are not always more tax efficient is that For some countries, there is the option to hold stocks in a retirement account in which if the company distributes dividend, it is not taxed. So that removes the tax advantage of the non-dividend payer. But more on that later. Now, let's see what the disadvantages of growth investing are. The first one is that generally these types of businesses are smaller, riskier ones with less history. This makes them a lot more volatile in bear markets and also poses a lot higher risk for your capital. As I said, there are outliers because Amazon is often categorized as a growth stock and it definitely is not a small company. But even if we account for the big corporations in the growth sector, like Amazon, Tesla, Meta, etc., they are extremely prone to violent downturns when the liquidity in the economy starts to go down and central banks raise their rates or implement quantitative tightening, which is a fancy term I use to make myself look smart. But it basically means pulling money out of the economy. We saw that in 2022. When you couple that with the fact that they're not paying any cash to their shareholders while their price is going down, it adds to the risk. This leads to the second disadvantage. When you invest in these companies, you don't get anything until you sell, which means you have to wait years and years and wait the price to go up to finally realize a profit. And that can certainly be a nerve-wracking experience. That means that the only way for you to profit is the so-called greater fool theory. When a company is not distributing cash, the only reason to hold it is to sell it for a higher price. But every single person that buys it thinks he's getting a bargain. Well, that's a logical failure. If everyone is getting the bargain and at the same time everyone is relying on selling the asset to someone else, someone in this chain of transactions will be left holding the bag. Each person buying it hopes they are smarter than the person they're selling it to and that the buyer will be the greater fool. The problem is, sometimes this greater fool turns out to be you. And it's hard to predict it. Why is it hard to predict? Well, because of the third disadvantage. It is really hard for an investor to assess whether the company is fairly valued or not. Because there is no dividend, you can't anchor your analysis or expectations into anything tangible that you get as a benefit. You are only hoping to sell it for a higher price. But the market is a forward-looking mechanism that is always looking ahead in the future. Just because you think a certain industry, let's say AI, has a lot of growth and development doesn't mean that the current companies in the industry are not ridiculously overpriced. A good example is the dot-com bubble. The dot-com bubble was the unsustainable increase in prices of internet companies in years 99 and 2000, which led to a huge bubble that eventually popped. Was the internet the next big thing? It definitely was. Were investors right to be excited about it? They definitely were. However, that did not stop them from losing a lot of money and investing in companies that went bankrupt. And if you invested in the Nasdaq index, which I will use as a representative of the growth companies at the time, you did not go back in the green until 2015. Think about it. 15 years just to break even from assets, most of which did not even pay you any cash while you were holding them. Here is a chart of the Nasdaq during the dot-com crash. The arrow points to its highest point in 2000. And then here is the point in which the price again reached the same level from the previous image. It is 15 years later in 2015. Remember, certain companies or sectors might have a bright future, but that doesn't mean that they aren't grossly overvalued today. Another disadvantage of growth stocks and investments in general is the fact that since you don't have any cash flow, if you need to fund any type of expense, you need to sell shares. Let's take as an example the famous 4% rule. It says that each year you're allowed to sell 4% of your shares safely because the growth of the market will make up for that. However, ask any retiree that got into retirement with that 4% rule during a prolonged bear market, and you will find out why this likely isn't a good idea. Here is the math behind it. Let's say you have $1 million in your portfolio. You are allowed to sell 4% of it, meaning $40,000. You have decided that this is enough for you to live, and so you decide to retire. However, market drops by 30%. Now you have $700,000. If you want the same 40,000, you have to sell 5.71% of your portfolio instead of the 4%. Oops. And if by some chance we enter into a so-called lost X number of years period and you don't have cash flow, things get really ugly. This phrase is used for a set of time in which the stock market isn't going anywhere. You will sometimes hear it as a lost decade in the media, but it can be for any number of years. Here is a visualization of what that means. It's a chart of the S&P 500 index that supposedly always goes up and is inflation adjusted. Now, granted, it does go up over time, but check this out. 30 years, then 24 years, then 15 years of lost periods. Will your retirement start being such a period? No one knows. It's a gamble. It's a gamble with your life. Can you afford that? Imagine what this famous 4% rule will do to your portfolio in such periods. You will get wrecked. The last disadvantage of growth investing I will talk about is the rebalancing issue. Naturally, you will get some companies or ETFs that will do better than other companies. It is an absolute nightmare to always think of which one to trim and which one to add to. Is it overvalued now? Or will it continue to grow and investors are right to be piling in it? What do I do? If I sell, when do I get back in? Oh no, I will pay a lot of tax on that one. It is a nightmare. Dividend investing eliminates that, at least for me, because my strategy is that I am interested into how much capital I put into a company and how much cash it gives me. And then I just stick to certain limits of maximum exposure, and that's it. All right, speaking of dividend investing, let's get into its advantages and disadvantages. Starting with the disadvantages. The first one that is always brought up is taxes. Generally speaking, dividend investing is more tax inefficient because when you receive the dividend, regardless of what you decide to do with it, you have to pay a tax on it. But not always. I will discuss the topic of taxes a bit later in the video and you will see what I mean. The next disadvantage is the argument that the companies are only paying dividends because there is no more places to invest the cash in. That is true. Usually, a growing company will need every dollar they can get so that they can expand and take more market share. Each dollar that they pay out to shareholders is a dollar that could have been used to open a new store in a new location, or create a new factory, or develop a new technology. I personally don't mind that since it shows me that the company is mature and stable, but this is something that comes down to your personal preference and the risk tolerance that you have. I like companies which are dominant in their niche or local markets and can afford to still grow, but also take part of the profit to reward me for investing in them. The last disadvantage I will talk about when it comes to dividend investing is that the dividends are not free money. I think that argument is a bit superficial, but I see it all over the internet, so it would be dishonest if I didn't include it in the video. The argument says that at the time of paying the dividend, the share price drops with the amount of the dividend. Now, while that might be technically true, it presumes that people think that something like free money exists. So, as I said, it is a bit superficial. And besides, as we discussed, the market is a forward-looking mechanism. That means that when investors identify a company as a reliable source of cash flow, they will naturally want to own it, which in turn drives the share price up. Yes, when the company moves its cash from its cash balance and deposits it into your bank account, it theoretically loses value. But hey, you get to pay your bills. So again, it's a weird argument and I won't spend more time on it. Now let's move on to the advantages. The first one is that as a rule, dividend-paying companies are more mature and stable. Generally, they have been around for longer, and besides that, the fact that they are paying out cash flow to the shareholders is a stabilizing factor. Why? Well, because of two reasons. First, dividends can be manipulated. It's cash in your bank account. There are no accounting tricks, GAAP accounting versus non-GAAP accounting. This stands for generally accepted accounting principles, etc., etc. Second, the commitment of the management to pay a certain amount of dollars to the shareholders is a disciplinary factor that holds them accountable and is more likely to stop them from making foolish decisions. The second advantage is that dividends are a lot more stable than share prices. If we take a look at any of the famous dividend pairs, you will see that. Growth investors worry about the price fluctuations non-stop, but the dividend investor can hold on to a quality business and just watch its cash flow grow, ignoring the ups and downs of the market. I have prepared a few examples for you. This is the 10-year price chart of Procter & Gamble. You can see the ups and downs. This is their 10-year dividend chart. Notice the stability? It is only up, no exceptions and no downturns. The 10-year price chart of Johnson & Johnson. Again, you can see the fluctuations. And here is their 10-year dividend chart. Same as with Procter & Gamble. All right, I think you get the idea, but here is one more, even more dramatic example. Here is Realty Income's price chart. A bit of a roller coaster here. Well, how can you isolate yourself from that roller coaster? By focusing on this chart instead. Here are Realty Income's dividends for the past 10 years. Which of these charts allow you to sleep better? As the saying goes, the picture is worth 1,000 words. There are a lot of other advantages of dividends and cash flow investing in general. It's now time to do a deep dive into what they are. We will explore why the argument that says growth gives you a better total return is a lie the majority of the time, and I will show you how financial media and other so-called gurus are manipulating you into thinking in such a way by showing you hard numbers that no one can argue with. Then I will go deep into the emotional and practical reasons why dividend investing is way better than growth investing by telling you 2 practical life stories, a topic that for some reason all the financial advisors, and I will call them nerds for the lack of a better word, miss when they're focusing only on their numbers and spreadsheets. But before I move to the next section, where I show you how you've been lied to, disclaimer time. This video is for informational purposes only. I am not an investment advisor or financial planner, and I have no idea of your personal situation. You bear your responsibility for the investment decisions you make and the risk you take. As you have heard many times, past results do not guarantee or indicate future results. Okay, now that the lawyers can't touch me, let's go into the next section. Here I will show you, using only math and charts, still with no talk of the emotional and psychological benefits, why dividend investing is actually more likely to give you better returns. See, when people show you charts of different companies or funds, you have to know that there are 2 types of charts: price performance charts and total return charts. And with the total return charts, you have to make sure that the provider of the chart has taken into account the reinvestment of the dividend, because a lot of them don't do it. You see, most of the videos or articles show you the simple price return chart, and then they try to convince you that this or that investment is better than the others. Or they show you a total return chart, but for some reason the total return doesn't account for your dividends buying new shares, which gives you more dividends, buying more shares, etc., producing the so-called dividend snowball compounding effect. In order to illustrate the dramatic difference between the 2 methods, I have prepared a couple of charts. In them, I will show you 3 popular, relatively high-yielding dividend stocks versus the Vanguard Growth Index ETF, ticker symbol VUG. Now, I don't want you to get bogged down into the practical examples. And no, I'm not cherry-picking companies to prove my thesis. The point is to illustrate mathematical principles that otherwise would be too complex to understand with real-world examples. I chose this ETF because it is one of the largest growth ETFs and is a representation of growth stocks in general, although it does pay a very small dividend. Okay, so let's load the charts. I will start with comparing VUG with one of the most popular business development companies out there, RS Capital, ticker symbol ARCC, which is known for its high dividend yield. This is what you would typically see on the internet. As you can see on the chart, the growth ETF crushes RS Capital with 531.72% total return versus RS 217.69% total return. A new investor sees that on a video or by looking at a simple Google search result chart and is thinking, this is a no-brainer. Is it though? I told you I will show you the truth in the beginning of the video? Well, here is the actual chart people need to be looking at. The results are a lot different now. Turns out, a boring business development company with share price has gone almost nowhere actually beats a growth ETF that has all the big tech companies in it. Here, RS returns 776.21% versus VUG 622.85%. The difference is, in the second example, the dividends have been reinvested to buy you more shares that give you more dividends, with which you buy more shares, etc. Let's continue. Here is a second example. Now, I will compare VUG with one of the favorite stocks of the dividend investing community, the real estate investment trust Realty Income, ticker symbol O, with a current dividend yield of 5% at the time of recording the video. As you can see, in the normal chart you would see in Google or Yahoo, etc., VUG beats Realty Income with a significant amount, turning $10,000 investment into $60,822 versus Realty Income's $50,571. But if we are looking at the chart with the dividends reinvested, then the picture is quite different. And we see that Realty Income has turned this $10,000 into $82,793 versus the fund's $69,772. Okay, one more example. Another dividend favorite, the tobacco giant Altria, with a current yield of 8.5%. Let's see what the comparison will tell us. As you can see, again, the normal chart shows Altria giving you 5.82% return versus VUG 9.79%. However, with dividends reinvested, you can see Altria's annual return changing to 12.82% versus VUG's 10.58%. And the tobacco giant is crushing the growth ETF by turning $10,000 into $103,000 versus the ETF's $70,000. Even the almighty S&P 500 loses the battle against these dividend companies when dividends are reinvested. Here is the S&P 500 versus RS Capital, with the business development company beating it with over 300% when dividends are reinvested. Here is a comparison with Realty Income, with the REIT crushing the S&P 500. And also a comparison with Altria, showing that if you compare the S&P 500 with the tobacco company only on price, the ETF is beating it. But when you factor in the reinvested dividends, Altria is actually again crushing SPY. Again, the point is not to say that it is better to invest in one company than an entire index of hundreds of stocks. Far from it. The idea is to show you how a good cash flowing investment actually crushes the alternatives if you are looking at the chart the proper and complete way. Why do you have to look at it that way, you might ask? Isn't the goal of the dividend to get it in my bank account so I can spend it? Well, you know the old saying that you have to compare apples to apples, right? If you're going to wait 30 years without touching your investment and benefiting from it in any way, as the growth investors suggest you should, then it is only fair to compare this apple to another apple and see the results for the same time period without benefiting from your dividend as well. Again, you can't compare an apple to an orange. And in the case with dividend investing, the great benefit is that the moment you decide to stop, you have a stream of cash flow that you can decide to pay for your life or not. And that option, unlike with growth investing, is always there and you can switch it on or off. Now, there is something I need to confess to you. Sometimes I have the weird ability to see what other people are thinking. And what a lot of you are thinking right now is taxes. You're wondering why I have not explained anything about them and have only mentioned the word a few times, saying I will talk about it later. Well, the reason is the following. When I teach you anything about investing, I can work with numbers and circumstances that are the same for everyone, everywhere. I don't care where you're watching this from, what is your income, and whether you are married or not. The charts I showed you are the same. But the reason I don't like to talk about taxes is that it is such an individual and diverse topic that there really is no point. This video will be watched by thousands of people in potentially 100 countries. Each country has its own tax laws. And Even within the same country, there might be different tax brackets. It might matter whether you are married. Maybe you have some real estate that you can use as a depreciation. Some countries have more favorable tax treatments of dividends than capital gains, or even zero taxes on them. Others have the option to invest in a retirement account where you can get the dividends and reinvest them, achieving the same exact results from the previous charts without paying any taxes. The point is, I don't know where you are and what your situation is. Taxes are the easiest thing to solve. Every local accountant that did not buy their degree is going to be able to tell you how much you should pay. So, with that said, I will move on. Apart from showing you how a good dividend company can crush a growth-oriented one, if you are looking at the right chart in the right way, I need to disclose that at the moment of making the video, I own shares in all 3 dividend companies I showed you. But I own a lot more. And I can tell you from experience that besides knowing that when I reinvest my dividends, I will probably outperform the passively managed growth funds over the long term, there is one other significant advantage of having a cash flowing, dividend-oriented portfolio. We already talked about the issue with having to sell shares in a bear market, or how it can cause you to panic when you don't receive any cash but are watching your stock price go down. Well, I had the perfect experience to prove my point. In the bear market of 2022, more than half of my 40 plus stocks and ETFs went down, some with significant percentages of 20, 30%, etc. However, I couldn't care less. I was actually excited because I could buy more shares at a discounted price with my dividends. And out of these more than 40 companies and funds, only 3 cut their dividend, and these 3 were my most speculative ones anyway, so I did not have that much exposure to them. All the others kept it, and a lot of them actually even increased it. So in the worst bear market in over a decade, when people were watching their growth stocks getting destroyed, I was actually watching my cash flow increase and was sleeping well. So all the things I am telling you in this video are actually coming from experience. If you would like to see my favorite 4 stocks I invest in right now, you can check the link in the description. I will send you a report with them, which will be up to date regardless of when you watch this video, because I am constantly updating it. So, you saw the charts of truth. Now, let's see studies that have been done on how dividends contribute to overall returns. An article by Fidelity shows that dividends have accounted for 40% of the stock market return since 1930 and 54% during decades when inflation was high. Another study done by Hartford Funds reveals that going back to 1960, 69% of the total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding. Also, in the same study, it is shown that companies that grew or initiated a dividend have experienced the highest returns relative to other stocks since 1973, with significantly less volatility. Okay, enough math. Honestly, I don't like math, but it is a necessary tool to use. Now, I want to show you the less discussed positive elements of investing for cash flow instead of growth, the psychological and practical ones. Because, let's face it, numbers and math and spreadsheets don't mean a thing if you can't execute the strategy or if it is making you miserable all the time. So let's dive in. First, I need to bust a very pervasive myth in the investing community, that investing is only a game of numbers and returns. It is not. You must always include the emotional and psychological factors. We are all human beings and we succumb to different vices and biases depending on our genetics, temperament, upbringing, and the life situation we are currently in. For me, for example, I take great pleasure and comfort in the fact that I know that my passive cash flow from my investments can pay for my standard living expenses. Now, some people would say that I am retired, and if I wanted to brag on Instagram to make myself look good, I honestly could say that, but the truth is I'm still working 15 hours a day. However, if something happens and I can't, or I just burn out and need to rest, I know that the income from my assets will be paying the bills, the food, the gym, and the fuel for the car without me having to work or sell any of my principal. This, to me, and perhaps to you, is extremely important. To never touch your assets and still be able to live off of them. And I would trade a few percentages of total stock returns for that feeling if I had to, gladly. Another psychological advantage of dividend investing is that it takes emotions like FOMO, or fear of missing out of the process. Imagine you buy company X. It doesn't pay any cash. You hold it for a year. It goes up 30%. You're now thinking, if I hold it just a little bit more, it might make 40%. Next thing you know, the stock crumbles. Or you have the reverse situation. You sell for profit, and right after you do, the stock shoots up another 30%. Now you feel like a fool. It is just an absolute roller coaster of negative emotions. Also, imagine how much more fulfilled you're going to be if you're constantly getting cash in your account, regardless of whether you spend it or reinvest it, instead of watching a line go up and down on a screen for years and years. Even if we are not talking about emotions, a super practical reason why dividend investing is better than growth investing, in my opinion, is that you can't pay your lunch if Tesla's price goes up, but you can with Procter & Gamble's dividend. I already touched on this, and I will also illustrate it in a bit with a real-life example. But just think how easier it is to calculate your monthly income and how much you can afford to spend if you have regular cash flow. Another psychological benefit is that dividend investing focuses your attention on the right things. When you invest only for price appreciation, you might get caught up in the latest trend or only focus on the stock price performance. However, dividend investors are much more interested in how the actual business is doing. As Warren Buffett famously says, you are not just buying stocks, you are becoming an owner in a business. When you need to assess how likely it is for a company to sustain or increase its dividends, you focus on metrics like free cash flow, payout ratio, interest payment coverage, and a lot of other metrics that I show my students in the Dividend Method program. You just become a better investor who is way more capable of evaluating a company's performance simply by shifting your goal and focus. In general, if a strategy or approach doesn't align with your emotions, you are screwed. It doesn't matter what financial return you get. At one point, the pressure will be too much, you will lose sleep, you will be miserable, and you will either give up or worse, make an emotional decision that will ruin you financially. A good example of that, which I can give, is the heated topic of home ownership. Should you own a home or should you invest the money and rent? This is something that I have argued about for years. The truth is this: if you have a dream of owning your home and want to have the pride of ownership, you should do it. I, for example, would hate to live in someone else's place. What you see behind me is part of my home that I fully own without any mortgages. Now, it is a relatively big apartment. Could have I used the cash to purchase several smaller apartments, rent them out, and find a similar apartment like this to move in, which I could rent? Probably. And I would have probably made $200 more in monthly passive income, since smaller apartments generally give you higher rent for the same space. Is it worth it for me? No, not at all. I like owning the place where I live, and this emotion is more important to me than the additional $200. But hey, it might not be for you. And this is why you need to know yourself and create an investment strategy accordingly. And since I spoke about real estate, I will illustrate to you another lie that you're constantly getting bombarded with, using land ownership as an example. The total return lie. The lie that if someone has a portfolio gain of 50% for the past year, they're doing great. The thing is, they might or they might not. This is why it is very important for you to understand the concept of paper return. For that purpose, I'll use an example of two investors investing in land. Let's call them Steve and Johnny. Johnny. Why does it always have to be Johnny? So, Steve is a cash flow investor. He has worked hard for years and has managed to save $1 million. Since he grew up on a farm with his dad, it has always been his dream to own farmland. So, he decides to invest in that. He finds a great piece of land in a rural area with a lot of demand from food producers. He purchases the land and immediately rents it to one of the many companies that produce corn in the region. The land yields $100,000 per year. Steve is happy that he fulfilled his dream and is collecting the 100K check every January. Okay, so now let's go to Johnny. Johnny is our capital gains investor. He is always looking for bargains and is dreaming of having a big exit on everything he does. He managed to flip a few houses by buying low and selling high, taking advantage of the economic boom due to the expanding of the car manufacturing industry and rising real estate prices in his town. However, he is not satisfied with that. He wants more. So, he decides to make a big move. He sees that his town is expanding and decides to buy a plot of land that is right next to the edges of the town, also for $1 million like Steve. There is no demand currently for that land and he can't rent it to anyone, but he hopes that once the urban area expands, builders of industrial or residential properties will approach him with offers. Everything goes according to plan, and each year the town grows, the land appreciates in value. By the 5th year, it has now doubled, getting to $2 million. Johnny feels great. He has finally made it. He made his big hit. However, since he sees his asset appreciating so much in price, he wants to wait a bit more so that he makes even more money. On the 6th year, there is an election. A different political party comes in power and changes the laws and regulations, forcing the main employer in the town's car manufacturing industry to move. It is not a complete disaster, but some people lose their jobs and the town stops growing. Real estate prices go down towards equilibrium after the incredible boom in the last 5 years. Johnny's empty plot of land is now worth $1.3 million. He still has no one to rent it to. He is afraid it will go down even more and sells. He is furious. Yes, he still made $300,000, but he could have sold last year and made $1 million in profit. On the other hand, Steve has collected his 6th yearly paycheck of $100,000 from the farmland he owns. The companies producing food are still using the land, and since there isn't that much of a boom in that industry, the land's value is still $1 million. However, Steve is okay with that. So, let's see what has just happened. If you had asked our growth investor Johnny on the 5th year how his investment is doing, he would have said he had made 100% gain and has doubled his money. While, at the same time, Steve has been consistently making 10% in yearly income and the value of his property was flat. As we all saw, however, just 1 year later, had you asked the same question to the two, you would have had a very different answer. Steve would have told you that he is collecting his $600,000 check while Johnny exited the investment with $300,000 for 30% gain. What's the moral of the story? Well, Johnny would have been thinking he's beating Steve's returns and would have been bragging how dumb Steve is to have this boring investment strategy for 5 years. However, here is the cold hard truth. You have not beaten anything until you actually sell and are in cash. Let me repeat. You have not beaten anything until you actually sell and are in cash. How many people have you seen telling you in person or online how their portfolio is doing and how they are crushing it? Have they sold? Are they in cash now? Can they go on a vacation with their portfolio gain? A lot of people thought they're becoming millionaires with the crypto boom in 2021, waiting for prices to go even higher, only to suffer 90% loss in 2022. Remember, the gains you see on your screen are paper returns. Until those returns are actually realized by you pressing the sell button and going in cash, it's just numbers and charts on a screen. It's not real. But when exactly do you sell? And if you do, what do you do with the cash afterwards? After all, it is now just sitting there doing nothing for you. This is what we will explore with our second story. But before that, if you gained any value and learned anything today, consider liking the video and subscribing to the channel. To be notified in your notification section of any future videos, you might also want to click the notification bell when you subscribe. It will allow you to not rely on the algorithm to see suggested future videos, and will also let me know that I should keep doing videos like this and that you enjoy them and find them valuable. Now, with the next story, I want to discuss the idea that underpins growth investing, that you can sell part of your investments in order to fund your lifestyle. And also, I will touch on the topic of companies distributing dividends because they have no better use for that capital. We already went through the potential pitfalls of strategies like the 4% rule that require you to constantly sell shares and what happens in a bear market or a lost decade. Now, I will show you the practical reasons why that might not be such a good idea. I will tell you about two friends, Richard and Jack. Jack. Is Jack better name than Johnny? I don't know. They went to university together, and right after they graduated, they decided to start their own tech startup. Richard and Jack did very well, and when they turned 30, they decided to sell it. They managed to exit for $8 million, splitting the money 50-50. So, now each of them has $4 million. Richard decides that he doesn't want to risk his principal, and he is not a fan of constantly monitoring share prices, so he decides to invest in 4 dividend-paying companies: Procter & Gamble, Johnson & Johnson, PepsiCo, and Realty Income. He manages to make $130,000 a year in dividends and adjusts his lifestyle to live pretty comfortably with that amount. He knows that the payout ratios and the business models of these companies are rock solid and that the management has proven it can manage the investors' capital in their best interest. Jack, on the other hand, is a growth investor at heart, and he wants to invest in rapidly growing companies in newer industries that will multiply his capital through the coming decades. He puts $4 million in Tesla, Google, Amazon, and Meta. Now, disclaimer, these are just examples of companies that are huge businesses and are not paying any dividends. At the time of watching this might have changed, but you can substitute any company with a company X that doesn't distribute cash to its shareholders. Now, back to Jack. Since he wanted to retire after his big exit, he decides to follow the 4% rule and will sell $160,000 worth of shares every year to fund his life, allowing himself to live even more comfortably than Richard. Now, let's analyze the situation of Richard and Jack. Who do you think can retire more comfortably? Who can spend the next decades knowing that he has X amount of money to spend every month? For Richard, it's pretty clear. Not so much for Jack. What if, in order to get his $160,000, he has to sell 6% of his shares for 5 straight years? What would that do to him emotionally? Watching his hard-earned capital that he hoped would last his entire life diminishing at a faster pace than planned? Or maybe he keeps the 4% rule, so now he needs to scale back his lifestyle. Or perhaps he decides that one of the companies is a bit overvalued and sells part of the investment to buy a new car. Is he right? Is he wrong? The moral of the story is this. When you identify companies and funds of great quality, you can comfortably let the management decide how much money they need to run and grow the business and how much they can afford to pay you. How do you do that with a company that doesn't pay you anything? Can you really say you know that Netflix is overvalued so that you can sell it right now and go on a vacation? And isn't it better to let the management of Johnson & Johnson decide that through their dividend? The point is, with dividend investing, you literally let the best management teams in the whole world decide how much you are allowed to spend without ruining your investment. With the growth investing strategy, you have to constantly decide that for yourself. Now, I don't want to underestimate you, but I guess probably 99.9% of the people watching this video won't do a better job in that than the management of the largest pharmaceutical or consumer products companies in the world that literally manage capital for a living at a world-class level. Talking about retiring, I told you earlier I have this weird ability to sense what people are thinking. And right now, some of you are thinking, but hey, I will just use my growth investments to grow my capital and then I will rotate into cash flowing ones. Yeah, I'm not so sure about that. That rarely works in practice. Do you really think you will invest with one strategy, research, think a certain way for 30 years, and then once you are 55, you are suddenly going to switch everything, sell everything, and plunge into a whole new strategy with all the wealth you have worked for the past 30 years? Yeah, right. Very unlikely. It's good to fantasize about ideal scenarios. It's another thing to actually apply them in real life. Again, it's not impossible, but it is just really risky and difficult. You have to learn a whole new skill set and change entirely the way your brain looks at investments. Also, the transition can be quite dangerous. What if just after you buy, a huge bear market comes and prices tumble? Do you dollar cost average? Do you buy at once? Or what if the bull market in your chosen growth companies continue? Do you now regret selling early? As you can see, it can be quite a messy and difficult to execute process. So guys, here is your complete guide on how to create your basic investment strategy. Will you focus on capital gains and growth, or will you focus on dividends and income? That decision is what underpins every other decision you will make in your investment journey. Some of you might be angry at me, expecting that the investment strategy was me telling you to put 40% of your money in healthcare, 40% in tech, and 20% in gold, or something like that. The reality is, you can't think about any of that stuff without getting really deep on what you want out of your investments and what general type of investment strategy you will follow. You literally can't even start picking companies and ETFs without having absolute clarity on it. And this is why I wanted to create this investment guide for you. It would be like wondering whether you want to take the highway or the more scenic mountain road before you even decided where you want to go for a vacation. Remember, without an overarching end goal, everything else crumbles. So, to sum up, we have gone over the pros and cons of growth and dividend investing, emphasizing what I think is the better strategy. I showed you how most of the charts and financial media out there are lying to you and what you need to know to make accurate decisions with your investments. We also went through the emotional, psychological, and practical reasons why I think dividend investing is a better strategy than growth with practical stories and examples. Of course, now is the time to make that decision for yourself. If you have decided that you want to pursue the growth strategy, then make sure you educate yourself, and I wish you the best of luck. It is not my thing, it is not what I do, so I cannot help you there. But if you decide that the dividend strategy is the way you want to start or continue your investment journey, then I invite you to join the Dividend Method program, where we do a deep dive into how to craft your strategy, how to pick ETFs and individual stocks, what metrics to look for, how to assess the risk, how to structure your portfolio for maximum results while minimizing risks, and a lot more. You can find the link in the description of the video. And lastly, when the video finishes in a second, I want you to go to the comment section and let me know what you found most valuable and what is your opinion on the topics we discussed. I personally read and reply to every comment I get. I'm really proud of you for staying till the end of such a long video. Thank you, and I'll see you soon.